Trump's tariffs would create the greatest wealth-building opportunity of 2025. But now I am staring at the sea of red across the markets. S&P 500 down nearly 18% from its peak, Nasdaq down over 21%, and leveraged ETFs like TQQQ getting absolutely demolished with 56% drop. Look at these charts. Absolute carnage triggered by the Liberation Day tariffs. S&P down almost 6% on Friday alone. Nasdaq plunging 6.07% in a single session. And while everyone else is panicking, liquidating and hiding under their beds, I'm getting ready to deploy capital in a strategy that could potentially generate a life-changing returns. Today I'm going to show you the exact playbook for these market conditions that could potentially turn this bloodbath into an incredible opportunity. Welcome to Psycho Investor, where we don't run from volatility. We harness it for potentially extraordinary returns. If you're new here, this channel is all about calculated aggression, intelligent risk management, and building wealth through unconventional strategies that most financial advisors are too conservative to even discuss. Before we dive into the action plan, let's understand what's actually happening with these tariffs and why most investors are getting this completely wrong. Trump's tariffs would create the greatest wealth-building opportunity of 2025. Why? Let's look at the history. America was literally built on tariffs. Before 1913, the US had no income tax. The entire government was funded by tariffs, and America became the wealthiest nation on earth. What most people don't realize is that we are seeing a return to this original economic engine. After World War II, the US lowered its tariffs to help rebuild Europe, Japan, and later Southeast Asia. US opened its markets while others kept theirs partially closed. This was called the Marshall Plan, applied to trade. But here's the problem. US never reset those terms. Decades passed, and many countries kept their tariffs high and trade barriers locked in long after they became competitive. By the 2000s, the US had one of the lowest tariff policies in the world, around 3 to 4% compared to partners like India and China with rates many times higher. This imbalance destroyed American factories and communities. Factories closed, jobs disappeared, and entire regions were devastated. What the market is panicking about now is Trump's Liberation Day tariffs. 10% across the board on all imports, with higher rates for specific countries like China 34%, Vietnam 46%, and even tariffs on European Union at 20%. The Wall Street narrative is that this will crash the economy, create the inflation, and destroy the market. But here's what they are missing. This isn't just about punishing other countries. This is strategic pressure to force a global economic reset. And I'm going to show you exactly why this could lead to a massive buying opportunity for the prepared investor. Consider this. When a country like United Arab Emirates just committed $1.4 trillion of investment into the US, Saudi Arabia promised $600 billion, and Apple announced $500 billion of investment over the next 4 years. They are not doing this randomly. They see what's coming. Reindustrialization of America that could create enormous wealth for those positioned correctly. Most people are confusing tariffs with inflation. Let me explain the difference. If you have 2 chocolate bars, one made in the USA for $2 and one imported with a 20% tariff now costing $2.4. That's not inflation. That's a consumption tax that sniffs purchasing behavior. True inflation happens when the government prints money, putting more dollars in circulation, chasing the same goods, and after that both bars cost you $3. So while everyone's panicking about these tariffs, I'm seeing one of the greatest investing opportunities of our lifetime forming right before our eyes. Now let's talk about how to capitalize on it with precision. I'm going to show you exact strategy for these market conditions, including how to size positions in this environment, which specific leveraged ETFs I'm targeting with precision, the mathematical reasons why market crashes are actually incredible buying opportunities, and the psychological framework that allows to buy when everyone else is selling, and also step-by-step process for deploying capital during market panics. Let me be clear, this strategy isn't for everyone. It requires discipline, patience, and certain psychological fortitude that most investors simply don't possess. But for those of you who are ready to think like a psycho investor, this could be the most important video I've ever made. First, let's understand exactly what we are looking at here. The screenshots I'm showing you reveal something extraordinary. A market in full-blown panic mode. The S&P 500 is down nearly 18% from its February peak, and now Nasdaq is down over 28%. But look at what's happening with leveraged ETFs like TQQQ. Down a staggering 56% from its recent high, and TSL3, the triple leveraged Tesla ETF, it's been absolutely demolished. Now most people see these numbers and feel terror, but I see something completely different. I see the exact same pattern that has created millionaires in previous market cycles. Let me show you the historical data that conventional investors ignore. Looking at previous significant corrections, March 2020, TQQQ dropped approximately 70%, then rallied over 1,100% in the following 2 years. Late 2018, Fed policy scare. TQQQ dropped 56%, then rallied 330% before the COVID crash. 2008-2009 financial crisis. If TQQQ had existed then, backtest models suggest a 90% drop followed by a 2,900% rally through 2020. This pattern isn't coincidental, it's mathematical. When you apply 3x leverage to a growth index that has historically recovered and exceeded previous highs after every major correction, the compounding effect on the recovery creates exponential returns. The key insight is this. Leveraged ETFs are designed to track daily movements, which means they experience what it's called volatility decay during choppy sideways markets. But the opposite happens during strong directional moves upward. They experience volatility compounding that can generate returns far exceeding 3x the underlying index over extended periods. Many financial advisors will insist these products are only for day trading. They are wrong. The math shows that buying leveraged ETFs during major market corrections and holding those recovery periods has historically been one of the most powerful wealth-building strategies available to retail investors. Now let's talk about the most critical element of this strategy: position sizing and psychological preparation. Look at my actual portfolio screenshot. Notice something important. While I am aggressive with my strategy, I am extremely disciplined with my position sizing. TQQQ makes up just up to 5% of my portfolio. TSL3, which is even more volatile, is mere 0.85%. This disciplined approach is what separates psycho investors from gamblers. We are not betting the farm on a single position. We are strategically allocating capital in a way that allows us to survive even catastrophic drawdowns, add more during market panics without emotional distress, maintain our core positions through the inevitable recovery, and capitalize on extreme volatility while sleeping at night. The psychological aspect cannot be overstated. When markets crash like this, most investors experience intense fear. Their primitive brain takes over. The same fear response that protected our ancestors from predators now drives people to panic sell at precisely the wrong moment. To combat this, I've developed what I call the psycho framework for market crashes. First, I expect and prepare for 70-80% drawdowns in leveraged positions. When they happen, I'm not surprised or panicked. I'm prepared. Second, I maintain significant cash reserves specifically for these events. Today's market crash isn't a disaster for me. It's why I've been holding more cash than usual. Third, I use a tranched buying approach. I'll be deploying capital in specific increments if the market continues falling. 25% now, another 25% if we drop another 10%, and so on. Fourth, I focus on math, not the emotion. The historical data shows that the worse is the crash, the more explosive the eventual recovery, particularly for leveraged products. Look at 2020 COVID crash. TQQQ fell from around $120 to $33 in a matter of weeks. Imagine buying at 50, watching it drop to 33, and then riding it all the way to 180 plus just a year later. That's the opportunity we potentially have right now. The mathematical reality is this. The S&P 500 has recovered from every single correction in its history. Every single one. The Nasdaq 100, which is what TQQ tracks, has not only recovered but substantially exceeded previous highs after every correction since its inception. If you combine these historical facts with the compounding effect of leverage on the recovery, you can see why these market crashes potentially represent extraordinary wealth building opportunities for those with the right strategy and psychological preparation. Now let's get into the specific details of how I'm implementing this strategy right now. First, let's look at my primary targets. I'm focused on three main leveraged ETFs. TQQQ or QQQ3, the triple leveraged Nasdaq 100 ETF. This gives us exposure to the world's leading technology companies with 3x leverage. The European equivalent is QQQ3, which gives European investors the same exposure without requiring professional investor status. TSL3, the triple leveraged Tesla ETF. This is my most aggressive play, providing concentrated exposure to perhaps the most innovative company in the world, but with extreme volatility. My execution strategy is methodical. Step 1. I've prepared a buying schedule based on specific market levels. For example, with TQQQ currently around $41, I'll deploy the first tranche of capital now with subsequent buys planned at $35, $30, and $25 if the market continues falling. Step 2. Position sizing remains disciplined. Even with all planned purchases, TQQQ will not exceed 10% of my portfolio, and TSL3 remain under 3%. Step 3. I'm using limit orders, not market orders, to ensure I get my desired entry prices even during high volatility. Step 4. I'm extending my time horizon. This is crucial. I'm not looking to make a quick profit. I'm positioning for a 12 to 36 month recovery cycle where the compounding effect of leverage can potentially generate extraordinary returns. Let's talk about European specifics. Since many of you are based in Europe like me, while US investors have direct access to funds like TQQQ, UPRO, European investors need to use equivalents like QQQ3 and 3USL due to PREEP regulations. These products trade on European exchanges and offer essentially the same exposure. For Europeans, using platforms that allow US ETF trading might require professional investor status, but the European equivalents are fully accessible and provide the same fundamental exposure. A critical note on execution. Never use market orders during high volatility with leveraged ETFs. The bid-ask spreads can widen dramatically, and you might get filled at prices far from your expectations, so always use limit orders with specific price targets. Now let's talk about balancing this aggressive strategy with stability plays that generate income while we wait for the recovery. Look at my portfolio again. Notice how I've structured it with foundation positions. BITO, ProShares Bitcoin Strategy ETF, currently 40% of my portfolio. While this has dropped significantly, it provides crypto exposure through a regulated structure and generates over 50% yield. QLD, Global X Nasdaq 100 Covered Call ETF, at 28% of my portfolio. This generates around 10 to 12% annual yield through its covered call strategy, providing steady income even in volatile markets. Main Street Capital, at around 17%, this business development company yields over 4% but has historically proved significant capital appreciation alongside its dividend. These foundation positions serve a crucial purpose. They provide stability and income that allows me to be aggressive with my leveraged positions. They are my sleep at night allocation that keeps generating cash flow even during market turmoil. I also use Ventus Energy and Indimo for my non-volatile part of portfolio. You can take a look at this video I published earlier. This barbell strategy is essential to the Psycho approach. High-octane, leveraged growth positions balanced by steady income generators. The income positions provide psychological comfort and ongoing cash flow that can be redeployed into growth positions during market crashes like we've seen now. What's particularly interesting about covered call ETFs like ULD is that they often perform best during high volatility environment. The premiums they collect from selling calls increase substantially when market fear rises, potentially boosting their yield precisely when growth positions are under pressure. Main Street Capital has also demonstrated remarkable resilience during previous market corrections. Unlike many high-yield investments that cut dividends during downturns, Main has maintained it and even increased its dividend through multiple crises. This balanced approach allows me to be aggressive without becoming reckless. I can deploy capital into severely beaten down leveraged ETFs while still maintaining a solid foundation for income-producing assets. Before we wrap up, let's address the elephant in the room: risk management. This strategy involves substantial risk, and it's not suitable for everyone. Here are the key factors to consider. First, leveraged ETFs can and do experience catastrophic drawdowns. The mathematics of daily resetting leverage means they can theoretically go to near zero in extreme, sustained downturns. Second, this strategy requires significant psychological fortitude. If you can't handle seeing positions down 60–70% without panicking, this approach isn't for you. Third, there is no guarantee that historical patterns of recovery will continue. While markets have always eventually recovered, the timing and magnitude of those recoveries vary greatly. Fourth, position sizing is absolutely critical. The strategy only works if your position sizes allow you to hold through extreme volatility without being forced to sell at the worst possible time. That said, for those who understand these risks and have appropriate risk tolerance, market crashes like we are experiencing now potentially represent extraordinary opportunities. Remember Warren Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful. Today's market is definitely by fear, and the big fear index is spiking. Media headlines are apocalyptic, and retail investors are panic selling. This is exactly when the greatest potential for future returns exists. The market doesn't reward comfort, it rewards those who act with calculated aggression when others are paralyzed by fear. So, if you're prepared to think differently about market crashes, if you have the psychological fortitude to buy when others are selling, and if you are willing to implement proper position sizing and risk management, now might be the best time to consider this approach. If you don't know what user-friendly platform to choose to start investing in Europe, check my description. Drop a comment below sharing your approach to this market crash. Are you buying, selling, or waiting on the sidelines? I'd love to hear your thoughts. And if you found value in this strategy breakdown, smash that like button, hit subscribe, and turn on notifications so you don't miss my next update as this market situation develops. This is Psycho Investor, reminding you that sometimes that craziest thing you can do is play it too safe. Stay psycho and stay profitable.